Hey, welcome back to Accounting 604. We are now in our video number 6 in Module 4. I was just looking up there at the title to make sure I got the number right. As you can tell from the title, this particular lecture is on the return on net operating assets, or RNOA. And as you might guess, conceptually, this is similar to our return on assets. But of course, really what we're doing is focusing specifically on operating assets rather than, well, every asset that happens to be on the balance sheet. So if we climb straight into this, we can see here that return on net operating assets, or RNOA, measures our operating returns and is defined as NOPAT divided by the average of net operating assets. NOPAT, of course, being the rather extensive mathematical exploration that we touched on in our previous video number 5 in this module. And so once we have calculated NOPAT, then we have the equipment or the calculations ready to perform our averaging out of beginning and end levels of net operating assets. And for Pfizer, our example company in 2022 for Module 4, we see the numbers here end up to be our previously calculated NOPAT of 31,393, and then we take the beginning and end level of net operating assets divided by 2. We do the simple math, we end up with an RNOA of 32.1%. Now this, of course, is calculated in the textbook if you want to see the math. But really, I guess what's at point here is, as you notice in the last 2 bullet points here, the textbook helpfully points out that the typical median S&P 500 company had an RNOA right around 13.5% in 2022, and it ranged, generally speaking, from about 10 to up to as high as, well, around 13.5%. So you consider that the return on net operating assets for Pfizer in 2022 is, well, more than double the return of the average S&P 500 company. Now, of course, every single one of us who got one or multiple vaccine shots in 2022, we have the actual painful reminders of why that RNOA was so high for this particular company, Pfizer, in 2022. So as we continue to consider this, of course, it begs the question, well, if we're going to go through all this effort to figure out the return on net operating assets, well, then how is it different than our common old variety return on assets, which we were calculating, well, all the way back in Module 2? How does this square up together? Now, what you're looking at on this slide, of course, is a table reproduced from your textbook. Now, if we look at this table carefully, there's a couple ways we could try to interpret this. But I think that maybe the most useful way to do this is to let's go column by column, reading down, and then maybe we will get a better sense of how to compare these two. So, traditional DuPont disaggregation and calculations suggests we take our net income, which of course is found on our income statement, and then we take our average level of assets from 2 different balance sheets, right? And we average that out, and then we do the rough calculation, right? Net income divided by average assets, and we end up, and this of course is in the DuPont column, the second column of this table, we end up with a return on assets of 16.6%. And we can similarly, because we're going to need this too, let's just figure out return on equity. Now, we've already talked about return on equity, which of course is very easily defined as net income divided by the average level of stockholders' equity during the period, and that is 36.3%. A healthy ROE, but again, we're talking about 2022 for Pfizer, right? And I think you can understand then why, if you sort of hold your finger at the 36.3 number and then just look at the accompanying 36.3 in the third column, the operating column, you'll understand, right? I mean, return on equity is going to be the same calculation, whether or not we're focusing on operating activities or encompassing both operating and non-operating activities. In fact, that's kind of the point of ROE, right? Is that ROE factors in not only return on assets, profitability, productivity, the way that we've disaggregated that, but also includes in a nod to the level and the effect and the influence of financial leverage, especially from an equity holder's perspective, right? So we understand why those two numbers are the same, and we understand that, of course, it has to be the same because both columns of calculations, whether traditional DuPont or focus on operating activities, ROE is going to incorporate our consideration of financial leverage. Alrighty, now that being said, when we return back now to the table, and now we're looking at the third column, where instead of bare ROA, we're really looking to calculate return on net operating assets and really focus on those and strip out the effects of non-operating activities. Well, follow along with me in the third column. We start with NOPAT, which of course we calculated in the previous deck. Net operating profit after tax, after we calculate and accommodate, add back in that tax shield, right? We end up with 31,393. And then we divide that not by average assets, but average net operating assets. And you see we take those two numbers, we divide them, and we end up with 97,741. We then do the RNOA calculation, which is simply NOPAT divided by NOA. We end up with 32.1%. Okay, so now we've done the bare math. But as you look at this table, I want you to notice a couple of things. Notice, first of all, that the difference in numerators is relatively small. It's very small, in fact, right? And what I mean by that is if you compare the number for net income in the second column with NOPAT in the third column, well, those obviously NOPAT, right, because it strips out the tax shield, right? It's a little lower. It's not a ton lower than net income. In a sense, we can say that the contribution of non-operating activities to income has been pretty small. Okay, that's the numerator of these two respective equations. And what I mean by that is the equation for ROA versus the equation for RNOA. However, look at the difference between the denominators of our two equations, those being average assets in the second column and average net operating assets in the third column. Whoa, there is a significant difference there. In fact, you could say it's roughly half of average assets. Net operating assets is significantly smaller. It's half of the level of average assets. And as a result, when you do the long division, so to speak, of calculating ROA and RNOA, you see this enormous, huge difference between the return on assets and the return on net operating assets, primarily, at least mathematically, because the denominator for the second equation for RNOA is so much smaller. Now, what is that really telling us? From a managerial perspective, we are saying that we are getting, or management is getting, a much higher yield out of the operating assets than if we blur the lines and just do the ROA calculation. In fact, if you then take a look at ROA's contribution to ROE, and just for a moment, think about what that conceptually means. What degree of the return on equity, to what degree is ROA, is the return on assets, is actual productivity contributing to ROE? Now, you can see here that just performing the traditional DuPont calculation, it would suggest that return on assets is a little less than half of the contribution of total return on equity. But if we perform the operating focus set of calculations, we get a much different picture. What the picture that this finer focus is providing is that operating activity really accounts for, well, almost 90% of the return on equity. And in fact, we might be able to deduce from that, right, that then whatever else is contributing to ROE, which in this case would be primarily financial leverage, does contribute something to make up ROE, but realistically, it's a very small amount of the contribution to this enormous return that equity holders are enjoying. So if we go into this, right, if we really take a good hard look at that last part on this next slide here, you can sort of see here, when we disaggregate return on equity into operating and non-operating return, and just, if you take a step back conceptually, those are the two parts that make up return on equity, right? The return on the operations side, the core business of the company, and what we would call non-operating return, which essentially is everything else. Now, you see the tiny little parenthetical note there that the non-controlling interest return essentially equals 1 for Pfizer. Now, realistically, it's not actually 1. You can see there below there for Pfizer, it's 1.00188, which mathematically speaking is close enough to 1 that it really doesn't even matter, right? And so Pfizer at this time had non-controlling interest, but it really didn't significantly contribute one way or the other. So essentially what we are saying is what's in this tan bar. The 36.3% ROE that Pfizer enjoyed in 2022, or I guess more specifically, you could say their shareholders enjoyed in 2022, was made up this way. It was made up of 32.1% accountable or attributable to the return on net operating assets and only 4.2% attributable to, well, the non-operating stuff. This is what would suggest a couple of things for Pfizer in 2022. First and foremost, that's a really, really healthy contribution from operating activities, as you would hope for as an analyst. You would hope to see that the company is doing very, very strongly and well in its core operations, and whatever financial manipulation or leverage it's using is not really making the difference in ROE. In fact, you can sort of see the separation here in that little table for S&P 500 companies from 2018 to 2022. The blue line is RNOA, and the red line is their ROE. And so you can sort of see there is, I guess, consistently about a 4% difference, if I'm reading this graph correctly, approximately from year to year. Some years a little bit larger, some years a little bit smaller, but consistently about a 4% contribution from non-operating returns. And essentially what that means is, in order, or at least what it suggests, is that in order to become an S&P 500 company, right, one of the largest, healthiest, we would hope, companies in the Standard & Poor's 500 listing of companies, that generally your operating return has got to be strong and consistent, and your non-operating return exists. You are engaged in non-operating activities that contribute to ROE. It's just not the largest or more significant part of your enchilada, so to speak. Alrighty, so this slide is again sort of what we've just touched on, right? ROE, and how does financial leverage contribute to ROE? As you can see here, financial leverage relates to the degree to which a company uses borrowed money to amplify the outcome of operations. It is an important measure of not only what the company is doing well with financial and capital structure strategy, but also the risk a company incurs with its reliance on debt. And so leverage is an important measure of risk. As it increases risk, it also increases the return to shareholders, right? Especially if the yield on the assets is greater than the cost of securing those assets, of acquiring those assets, the borrowing rate on the debt. And so you can sort of see here we've reproduced here what our insight into this company is by using first the traditional DuPont disaggregation and comparison, and then narrowing it to this operating activities focus. We get a much clearer insight into how Pfizer is generating its returns with the operating approach. The math, I would suggest to you, is worth it. It is not inconsequential. I realize that both understanding and comprehending the principles, as well as doing the math and lifting the heavy labor, for instance, in your homework problems, is not a small thing, and yet the insight it provides is really striking. So, as we wrap up this deck, what are some insights that we might suggest on this topic of return on net operating assets? Number one, you can see here that our focus on RNOA is a sharper measure of core business performance. It clears out the effect of financial structure and strategic capital management to give a clearer picture on the returns from operations alone. And the decomposition highlights the role of, well, I think I misspelled that, non-operating returns. And as we saw here, right, for Pfizer in 2022, right, you see that 36% ROE was really 32.1% from operations, and just the normal average S&P 500 4.2% from non-operating activities. We remind you once again then, right, that leverage is important. It does amplify your returns, but it does also add a degree of risk that we cannot ignore. So I hope that this is all helpful. I hope that this helps to sort of circle the wagons or bring all of these things into high relief, why we are exploring these topics, these individual specific topics, and how they all put together when we start doing actual financial statement analysis. Alrighty, we will see you in the next and the last video lecture of module number 4.